Good morning all and welcome to today's video. So I have the same three pairs on watch today. Those are Euro CAD, Euro dollar and pound Aussie. So there's been a little bit of development on the lower time frames, or price has just been stalling around, but we factor that into our forecasts and make adjustments where necessary. So I'm going to break these pairs down for you now. So Euro CAD, Euro dollar and pound Aussie. So on the higher time frames, you will know if you've been watching my videos regularly that the reason I was looking for this is because we have the sharp move down, sharp move up, giving me a clue that there's potentially a lot of liquidity in this area, which could send price rallying to the upside with a similar level of aggression as it rallied last time around. We tap into this area. I've touched on in previous videos how on the higher time frames, when we have a liquidity point, we usually break below it before rallying to the upside and break above before rallying to the downside, versus the lower time frames where we typically just tap into the area. We do sometimes just wick slightly below, but the higher time frames is typically where we see what we call people caught the wrong side of the market, who typically sell the lows and buy the highs. Okay, that's why they're not profitable. So what happens? It breaks below. We catch people the wrong side of the market. The bigger players see this when it breaks below as a bargain area of value for a buy. So they start buying and price rallies to the upside with a similar level of aggression as it rallied last time around. Okay. We also have what we call a near miss up here. So when price gets close to an area of value, but it doesn't quite tap into it, price will often find its way back up to that area to take out the high or the low on the flip side before potentially rallying, pushing to the downside or forming continuation, a correction above to push higher. We also have a larger flag halfway between a range, which is typically what we see. If we assume the range is from here to here, we have a larger correction for that potential impulse correction continuation, which is the natural ebb and flow of the market, and why I'm interested in a trade to the upside, particularly when you can see just about the price is in this area, this high area of value for a buy, where we've had a low, we've had a near miss. And if you paid attention to what I've just said, when we have a near miss, price will often find its way back down to the area that it near missed to, in this case, before potential continuation to the upside occurs within this impulse correction continuation. You can see just about on the weekly chart that we have this bullish high test candle there that wicked below, caught people the wrong side of the market. We push below. People believe that this is now resistance because we break below. The bigger players see this as a bargain area of value for a buy, so they start buying and it pushes up. Okay. So on the higher time frames, you can see that we have this, excuse me, we've had some very bullish momentum come in, and you can see we're now correcting above this little piece of structure, which will be more visible as I drill down to the lower time frames. We have this 1, 2, 3, which is typically what we see, the three waves, the three drives. First drive up, failed drive, second drive up, failed drive, which comes close to this liquidity point, and this one, which makes it even more likely that we will come back down and then push up with the final drive, which then breaks above the whole structure, and then we have a correction afterwards for that potential impulse correction continuation. So the exact same thing that we're seeing on the higher time frames, we're also seeing as we drill down. So the patterns that we look for, those of us who trade the Falcon strategy, are fractal. When we get patterns within patterns, we also have a 1, 2, 3 at the end of this 1, 2, 3, increasing the likelihood of this pushing to the upside, as does the fact that we have a corrective last part of the move. So we move down with momentum, which is often what we see when the sellers are getting out of their positions. And then look, how did we move down to this trend line? We move down correctively. Okay. So if we move down correctively, when we move down correctively, particularly when we do so at an area of value, that usually implies an impulsive move to the upside. And then when we get a correction afterwards, that implies impulse correction continuation, which is exactly what we've got. Now we have, I was talking about the market evolving on the lower time frames. The market in this instance has evolved on the lower timeframes, and we have what we call an expanding pattern. Okay, so previously yesterday, you will remember if you watched my video, I'm going to drill down to the 15-minute chart just because it's more applicable in this instance. You remember yesterday that I was looking for price to tap into this ray line, and I was looking for the same thing I'm looking for now. I was looking for a push up and a flag. However, what did we do? If you've been paying attention, you will know what we did. We near missed. We near missed to this area of value. Okay, what happens? Price pushed up, we get a sharp move down. What do we know? When we get a sharp move down after we've near missed a previous low, that usually implies that there are still orders in this area and orders being placed in this area that are dragging price down, which is why it failed to commit with an impulse correction continuation. We got the impulse, but then we got an impulse back down. Okay, implying that there's liquidity being placed down here and still in this area, which needs to be filled before price can rally to the upside. Okay, given that price action is just the mid price of the ask and the bid, right? So if we look at this, we have, if we just study this bit of price action here, I think it'll be useful. So what did price do? We pushed up, we had a tiny little correction here. We break that correction, we come back down, we retest the back end of that, and then we go into this little mini running channel. That's a terrible drawing, but bear with me. We have this little running channel. One thing that I ASR'd, ASR for those that don't know stands for Advanced Self-Review. One of the things I wrote in my Advanced Self-Review at the weekend, which is what I do to try and improve the quality of my trades and my trading, is that typically speaking, one of the things that I've noticed is that price will rally from an area of value more aggressively when it happens to be the base or the top of a piece of structure. Okay, and we have this tiny mini piece of structure, and we have what we call the 90% rule. So the base of a piece of structure is what we call the 90% rule. Those of us who trade the Falcon strategy, which just so happens to be where price retested the previous structure, where the liquidity is likely sat. Okay, so when we have the base of a piece of structure, which also happens to be where price retested something else, I am micro analyzing this, but I'm doing so because of what price subsequently did and because it all makes sense relative to the structure that is formed. Okay, so because of that, and because we near missed that area, it's no surprise to me, particularly when we near missed the previous low, why we are potentially, by the looks of it, coming back down to this area. So what, with that, all that in mind, what I'll be looking for today. So yesterday I talked about how expanding patterns give us more room to manage the trade. If you remember previously, when I had my trend line we were in this area, we rejected from, where were we? Yesterday morning, we were kind of in this area, and I think I had my trend lines like this, okay? And we were here, and I was anticipating the push down, the push up, and I said that I'll be able to manage it up to this high. I was just cutting through that wick because it didn't make sense so much in terms of the structure. But since prices evolved a bit, one of the reasons we kind of like these expanding patterns is because they typically give us more room to manage the trade. And what I mean by that is what these expanding patterns typically are. They're a failed drive to the upside, which kind of breaks out and then breaks back in. So people are getting caught into the buy positions too early. And the reason they help us to manage the trade is because if we get what I'm looking for today, so price tapping into this area of value, followed by a push up and a flag, then I will be able to manage this. Let's say this structure was parallel, okay? So let's say this structure was something like this, okay? I would have less room potentially to manage this to the trend line and to the top of the structure versus when we have a structure like this. Even if we cut through the wick as I've done with this trend line, that still gives me a risk to reward of potentially 5% if the trade was to shape up as I've forecasted it. Of course, we don't know the size of the flag. If we tap into this area and we push up, we don't know the size of the flag. We don't even know if we'll get a flag. Sometimes price just rallies and there's just nowhere to get in. But just thought I'd explain the mechanics of what we call an expanding pattern. So when we get an expanding pattern is either higher highs within a structure and lower lows, or higher highs and equal lows, or lower lows and equal highs. Okay, so that's what we call an expanding pattern versus a parallel piece of structure, which typically just moves more in that kind of manner, as I was just explaining a moment ago. So that's what I'm going to be looking for with EuroCAD. You can see price trickling down. We shall see what price does, and that is what I'll be looking for on that pair. And you can see the alert set there to see if we tap into the area. And of course, if we don't, then I will not be looking to place a trade. So moving on to the next pair. So euro dollar on the higher time frames. If I just zoom out. So zooming out, what happened? It's a similar story as with EuroCAD. We tap into the last exchange of liquidity. Okay, there's no other exchanges of liquidity that I can see. There's nothing to the left, so therefore it makes sense why many of the people who caught this move to the downside would be getting out of their positions here, knowing that there was an exchange of liquidity, and that price, if there was an exchange of liquidity last time around, there will likely be an exchange of liquidity the next time around. That's exactly what we got. What happens? Price taps below. This now represents an bargain area of value for a buy. For many of the big players, many people would have thought that this was now resistance when we break below, so they would have started selling and got themselves caught the wrong side of the market via what we call mass psychology, for obvious reasons. Okay, we even have a kind of near miss. We break below here, we come reasonably close to this exchange of liquidity, scoot back up, scoot back down, tap into that area, and then price moves up with a similar level of aggression as it moved up last time around. Okay, what do we have? We also have, I've just evolved my trend lines to the two most recent touches, and you will see a touch as we draw down here, as we draw down to the lower time frames. But we kind of have not to the same extent as EuroCAD, but we have a little bit of a near miss to this area here. But what we do definitely have is we have a near miss to this area and a slight near miss to here, giving me a clue that price will likely scoot back down, take out this low and take out this low, which kind of happens to be the last line in the sand. Okay, the last exchange of liquidity that I can see on the higher time frames for that potential impulse correction continuation to push higher to potentially take out this high here. Okay, and then if that was to happen, we would likely evolve our trend lines, and we would have something like this, which also makes sense. We would have a potential 1, 2, 3 into this area. So all of this makes sense to me at the moment. You can see we've moved down here fairly correctively, and we've tapped into this area. This is a prime example of people getting into the buy positions too early. Remember previously I said that I was looking to get long here because we tapped into this area, which happened to be the start of a piece of structure, the 1, 2, 3 there. And that I was looking for push-ups, a push-up and a flag. And did we get one? We didn't really get a flag. There was no flag here, identifiable flag with two tops that I could identify. You could argue this was one, but look at the move up. This was the clue, okay? So we tapped into this area. We tapped into, let me just draw back out on the daily. We tapped into this area. So we broke below this area, but we didn't break below this area. And as I've said previously, we often need to break the lows before rallying to the upside. So when we only tapped into this area, I was mindful of the fact that we could scoot back down to break this low before rallying to the upside. And the clue was this, okay? Look how we moved up. This was the big clue for me. We moved up with aggression. Look at this sharp move down. Why is there a sharp move down like that? Probably because there's orders still in this area dragging price down and orders being placed in this area excuse me, that need to be filled before price can rally to the upside. We then got another sharp move down. So impulse up, sharp move down. So when I see price do this, when I see these sharp move down, impulse, sharp move down, that gives me a clue that is orders down here that are dragging price down. Okay. So if you look on the daily chart, I'm just going to have a drink of water because my voice seems to be giving up on me. Right, let's try again. So you can see we have this potential. So we had a bearish daily close yesterday. Now, if we push above this wick, if I just zoom in, if we push above this wick, we have potentially the start of a morning star formation, okay? So if price starts pushing above this wick here, we have potentially the start of a morning star formation, which could be the catalyst or one of the catalysts for price to move to the upside. So with that in mind, you can see the mechanics of the market here. Price taps into this area. We get two rejection candles, or certainly this one. What do people think? What are the masses thinking? They're thinking this is a retest to go short. It comes back up again. People think, oh, well, maybe this is the retest. So then they start getting short. Okay, it comes up again. So this is what we see these patterns over and over again. So people think that because this is broken below, this is now resistance. Of course, the market can do anything at any time, but you can see the psychological patterns on the chart that repeat themselves. So what I'm going to be looking for is I'm going to be looking for price to break above here, because if we break above here, that is the high of the previous daily candle. And as I just said, if we break above that, then we potentially on the daily chart have the start of that morning star formation. So if we break above this high, I'm not too worried about this being part of the structure, because the higher time frames hold more weight. And if we break above that high that I was talking about, and we get that start of that morning star formation, that holds more weight than this. Okay, so if we break above this and we correct, that gives me a clue. The correction is likely after the impulse up, the banks and the big players stacking their orders for the next wave higher. And if we got that, then and I was able to get long on the break or within the flag, then I will be able to manage it up to these highs, even this inflection point here, for something in the region of 4 to 5%. So that's what I'm going to be looking for. And even if this turns into some kind of bear flag to push lower, I'm not getting that impression at the moment. Even if it turns into a 1, 2, 3 to push lower, there is still profit potential within that move before price moves to the downside. Okay, if it does indeed do that. So just speeding up, that is what I'm going to be looking for from euro dollar, speeding up and onto pound Aussie, because these videos I'm only allowed a 20-minute window. So pound Aussie, we have broken above. This is more visible on the daily chart. We have broken above this sharp move here. We have this sharp move up here, sharp move down. We then wick to that area. And so therefore people would have had their ray lines on here. It pushes above, people get caught the wrong side of the market, and then we have a series of impulse correction continuations to the downside to potentially take out this low here, this near miss to the start of this piece of structure. Okay, the base of this piece of structure, the 90% rule. So that makes sense. So we're well and truly in a run of momentum to the downside, and you can see this larger flag starting to form here. Okay. So previously, yesterday, I said that I was looking for price to tap into this area and push down. However, I thought that we might break a little bit higher, because we tapped into this area once, we tapped into it again, we kind of tapped into it a third time, and price did not find enough liquidity to send it skyrocket into the downside. Instead, it found liquidity from under here and pushed back up, giving me a clue that there was potentially orders above here. I thought that it might break just above and then break back in. However, we've moved up to the next inflection point, which just so happens to be the causation of this aggressive move to the downside. And if we just microanalyze this on the, if you look at this, you can actually see, I've got to be mindful of the time because I'm running out of time here, but we also have the start of a piece of structure, a 1, 2, 3. And if you remember what I just said a moment ago, the start of a piece of structure is often where price finds liquidity for the move to the downside. So we tap into that area, we wick out the orders, we push down correctively, and I'm mindful of that we've pushed down correctively. But what it looks like we've done is we've pushed down, we've corrected, broken below, taken out some more orders that were in this area, and then pushed down with aggression. However, I am mindful of the fact that we've moved down correctively on the lower timeframes. So because this could be an impulse correction to push higher like that, to tap into this high here, particularly given how much of this move down we've actually retraced now, what I'm going to be looking for is the following. I'm looking for price to break below the start of this correction. Then that negates the possibility of this turning into a larger bull flag to push higher. So if we push below this low and we flag, you can see we're pushing back up, and that's why I'm looking for this. If we break below and then we flag, then that will have negated that, and I'll be looking to get short either on the break of this flag or within it, and I'll be able to manage this down to these lows. That's what I'm going to be looking for, folks. I hope you're taking some value from this, and I will be back tomorrow with another video. Thank you very much for watching.